Okay, to calculate, to answer this question, you must first and foremost always extract all the information that we have. Okay, and then from the information that we have, we can actually classify which will go into which, because we know we have to calculate the initial outlay, the before, and then the during, and then the after. Alright, what will go into initial outlay? The before we start, this is before we start the project, we want to buy the machine, so that's initial outlay. And transportation directly related to the machine, initial outlay. Installation directly related to the machine, initial outlay. Oh, we have useful economic life, so that must have we must use that for calculation of depreciation. So depreciation is basically during, because depreciation happens every year during the project, so that will technically go into our DCF. Inventories, oh, it says we have to invest in inventories, so that technically initial expenses, so initial outlay. Sales will increase every year, so that's every year is during, so differential cash flow. Labor decrease every year 40,000, so that's during as well, so differential cash flow again. Maintenance increase every year 8,000, every year means during, so differential cash flow again. So we have salvage value of 0. So salvage value is the value of the machine at the end of the project life, so that is technically the terminal cash flow, or related to the terminal cash flow, right? Okay, so now we can start calculating. First, we want to calculate the initial outlay, question 1. Question 1, initial outlay. Alright, what happens to the initial outlay? First, we want to calculate initial outlay, always it's cash outflow minus cash inflow. How much we have to spend and how much are we getting back. So in this case, are we actually getting back anything? No, because we don't have an old machine to sell, so the cash inflow is basically 0. Okay, so you can actually slash this off. Alright, okay, what do we have? We have a cost of our machine, which is 420,000, and then we have our transportation costs and installation costs. Okay, so remember we have identified all this, so we can technically cross this off. Alright, so the total cost of our machine is 450,000, and then we include our working capital requirement. Remember, working capital is current asset minus current liability, but in this case we only have inventories, we only have increase in current asset, which is 20,000. So that makes our net initial outlay 470,000. Alright, easy peasy, isn't it?